Hi, I'm Jonathan Rudis. Welcome to this week's session of Real Talk. I have my guest today is Tom Stringer from Ryan and Company. Tom is a good friend and in charge of incentives and site selection. Tom, just give us an idea of what it is you do for Ryan and Company.
Sure, we work with clients all over the country that are looking at their footprint, deciding on labor, capital investment, people decisions, and facility decisions, and we help work with them to determine the right location and then to work with state and local officials in those jurisdictions under evaluation to negotiate incentive packages for them.
So, how long have you been doing this?
Since 1999, so it's been a while. Seen a lot of interesting things both here, political changes, economic changes, the ups and downs of the tech boom, market crash, the real estate crash and rebound. And quite frankly, since the Great Recession, there's been no bigger political opportunity than to be a job creator in government. So it's an interesting time for this right now.
So it's about jobs.
Always been about jobs, and more so now than ever.
And you're a Long Island resident, have done a lot of your business on Long Island?
Long Island resident from Bay Shore originally, still live real close. I'm about a half-mile away from where I grew up, but most of my work's around the country. I'd say I do about 30% of my work's Long Island or New York based. It's been interesting because I've seen Long Island go from a place that was growing by default in terms of proximity to New York City to a place that didn't really believe in economic development to, quite frankly, one that is now completely dependent on it to keep jobs here.
And just to outline some of your larger transactions in the last couple of years?
Worked with Arizona Ice-T to negotiate the incentives for their corporate headquarters, Luxottica's corporate headquarters, Marchand's corporate headquarters and distribution campus, Broadridge's corporate headquarters in Edgewood and operations center, and probably a dozen or so other projects in the last 5 to 10 years.
Great. The theme of our program is how to reduce your real estate costs, not only for companies but also landlords. But essentially, I would think that the majority of your work is for corporations who have, jobs in a particular place. So, what exactly, or how exactly, would you help a company reduce their real estate costs?
Sure. As companies look at their footprint when leases are coming due, or if they're contemplating adding employees, retrenching in terms of the headcount and reducing headcount, adding capital, changing business, adding divisions, as they really look at that footprint, at the end of the day, everything revolves around real estate at some level in a company's life. Where can we do this particular service or manufacture this particular item better than anywhere else? And that fundamentally becomes a location decision. So we'll work with companies at the real estate director level, at the CFO, CEO, and tax director level to determine, okay, we need to be here or here, and we can afford A or B. And the cost model of a location decision is the labor cost, the building cost, the utility cost, and all those transportation, all those sorts of things that go into it. And incentives becomes a big part of mitigating those costs in certain areas. If you're up here in the Northeast, we know that our property tax burden, our income tax burden, our transportation burden, and our utility burdens are much higher than anywhere else in the country. So what programs can we take advantage of in the states of New York, New Jersey, Connecticut, Massachusetts to mitigate and offset those costs so that the differential between a cheaper location, let's say in the Southeast, is not as stark as it is once the incentives are applied here in the Northeast.
Now, you're part of a large international,
International, yeah.
Accounting firm, and I'm assuming that that accounting firm infrastructure helps you put together that model and understanding the tax ramifications as well as all the basic financial ramifications of the incentives that you negotiate. That's a fairly monumental task, especially for companies like Broadview had how many jobs that were in the balance?
About 3,000 jobs.
3,000. So having been tied to the accounting firm is a big advantage.
I would think so. I mean, at the end of the day, fundamentally, every incentive ties back to the tax return of the balance sheet. And you have to understand how they're going to interplay and affect either earnings per share for a public company or the tax return. And historically, a lot of states offered tax credits, enormous tax credits to companies as an incentive. But based on standard state and local tax planning, federal tax planning, or nexus issues, companies couldn't use those tax credits. So tens of millions would be offered, but really the usable portion of them was much, much smaller. And that's lost to a lot of folks in the public who read this in the paper. But we're predominantly engaged after we identify the finalist locations to make sense of the incentive offers that are put forth. What's usable, what's real, what actually will affect our operations and reduce our costs. And you would be stunned to find out how much really is usable. It's a small portion of most incentive agreements. And the states that really are aggressive at putting out usable, tangible benefits are the ones in the last couple of years, certainly since the downturn, that have seen a huge rebound in terms of employment, jobs, population, and property tax values in terms of increasing.
That sounds huge. Let me ask you this: Who would qualify for your services? I mean, is there a kind of benchmark that?
We're a transactional business. I mean, there's not a business that's too big or a business, quite frankly, that's too small. They can't utilize incentives. And in a state like New York, which, for all that it's criticized, actually has an aggressive suite of incentive programs that runs the gamut. So those that are designed for small business and those that are designed for your Fortune 10 type of headquarters companies. There really is a program or a suite or a package of programs that can fit all of them. So we work with companies that might be
As small as
25 or 30 jobs in Hauppauge that are looking to expand, or companies that are looking to do major corporate headquarters in New York City or elsewhere in the state.
I don't think people really understand that. I think that people think that the incentives are just for the larger thousands of job kind of firms, but to know that they're available for the 25-person firms, that's very interesting.
It's a big misconception, and I'll tell you, personally, our team really likes working with small and middle market businesses because the incentives are much more tangible to their decision-making process.
Sure.
It helps them out significantly more because these are typically firms that are running on tight margins, are private or family-held businesses that employ 25, 50, 100 people, and we like to call them, those are your recession-proof companies. If you have enough of those in a healthy economic ecosystem, well, you're going to weather any storm. If a big employer comes or a big employer closes up shop, is acquired and moves away. Those mid and small-sized companies keep you healthy. So incentives really need to be targeted at them to help them weather those storms and compete aggressively against cheaper locations.
And given that there's, I guess, so many of them and not that many economic development people in comparison, it's there's a lot of money left on the table and a lot of economic development assistance that's left on the table.
There is a ton, and I will tell you, up here in the Northeast, we're late to the economic development game. I mean, if you look at the southeastern states in the U.S. and if you look at the West and how the auto industry and the aerospace industry and the tech industry has shifted to the southern states, it's predominantly because of aggressive economic development policies, cheaper real estate, and cheaper labor. Now, labor rates in the U.S., if you look at it to be completely objective, have really homogenized. I mean, it costs as much for an accountant or a lawyer in New York as it does in Chicago, as it does now in Miami, or as it does in Dallas. The wage differentials are small. They're between 5 and 10%. So with that being a huge driver, being fairly consistent, it's the other matters. It's the real estate, it's the utility, it's the personal income tax. Those sorts of things really are material to the decision-making process. And again, incentives can really be used well to offset some of those differentials. So in the Northeast, we really, I would tell you, got into this business in the last 10 to 12 years, and really aggressively in New York in the last 4 or 5.
Right. So we are going in the right direction.
I would tell you, I'm very optimistic about what we've done here. If you look certainly on Long Island, what the folks in Nassau County have done and what the folks in Suffolk County have done. Nassau has become really a polished local, the IDA, a polished local aggressive economic development organization that I put on par with some southern states in terms of how they go out, how they try and recruit, how they just touch their community. Suffolk, while a bigger landmass but a smaller business community, Suffolk's done a nice job in creating some programs that are unique, from some of the startup programs, the incubators, to being really aggressive and taking what was done in the town of Babylon and applying that at a county level for mega projects like Broadridge and some other players to kind of stake their claim that, hey, we're going to do things a little bit differently. I think both counties have done an excellent job, you know, and we're in proximity to the greatest economic engine that the Western world's ever seen, which is New York City. And for too long, folks on Long Island, folks in Westchester, folks in Rockland, even North Jersey, have pretended that, no, we're a different world, we're a separate animal. No, we're linked. We're completely dependent, whether we like it or not, on New York City.
So, how long is the cycle? I mean, how early does a company have to start talking about incentives for it, you know, for them to get them? I mean, I understand we have our certain, in real estate, there's a certain you know, cycle or timeline. When we add economic development incentives to that cycle, what I'm trying to figure out is if I have a, let's call it a 50-person company, right? How long is it going to take us to actually make that deal? I mean, that's a question I'm always asked. Right? When should we start talking? When should we start looking? And that 50-person company isn't someone who's got a whole portfolio question.
Yep.
They come to me and they say, you know, 50 people, I need 20,000 square feet. When do I start looking?
Yeah.
Right? And I generally tell them, well, you got to figure construction time and search time and deal time.
18 to 24 months out is really ideal, because you look at
Never have that time. Can I do it in a year?
Can you do it in a year? Yes, no question.
Sounds good. So that's ends our session of Real Talk today, and I want to thank Tom Stringer, and we'll have you back to discuss other interesting topics related to reducing real estate costs for corporations and landlords.
Great. Thanks, sir. Good to see you.
job.